Same city, same income. One person rents, one buys. In 5 years, who comes out ahead? In 20 cities across 4 continents, the answer changes completely depending on where you are. The rent versus buy debate has one correct answer. It depends on the math, not the emotion. Building equity is not a reason to buy if the price-to-rent ratio makes ownership a losing proposition. Throwing money away on rent is not a reason to avoid renting if the buy cost destroys your return. We ran the numbers across 20 cities globally, from Austin to Amsterdam, Tokyo to Toronto, and the data reveals which cities strongly favor buying, which strongly favor renting, and why the standard American advice about homeownership doesn't export well internationally. Before the cities, the framework. Price-to-rent ratio. Divide the home purchase price by the annual rent for the same property. Below 15 means buying is financially compelling. 15 to 20 is neutral. Above 20, renting typically wins on pure math. But ratio alone isn't enough. You also need to factor the true cost of ownership: mortgage principal and interest, property tax, insurance, maintenance, typically 1 to 2% of value annually, plus opportunity cost of a down payment. A $1 million home with a 20% down payment locks $200,000 in capital. At 7% in equities, that's $14,000 per year in foregone returns before you count mortgage interest. The break-even horizon, how long you must stay to beat renting, should drive the decision as much as the ratio. Cities where buying clearly wins. Detroit and Cleveland, price-to-rent ratios of 7 to 9. A $300,000 home rents for around $2,500 monthly. That's a ratio of 10. Mortgage at 6.5% on $240,000 is $1,500 monthly, with a pathway to full ownership. Buy. Indianapolis and Memphis follow at ratios of 11 to 13. Midwest markets with strong rental demand, landlord-friendly law, and low price appreciation risk. Kansas City, Oklahoma City, Birmingham, all below 12. These are markets where the mortgage payment is less than or equal to rent, making buying mathematically dominant almost regardless of time horizon. Cities in the neutral zone, where the math depends on your timeline. Dallas and Atlanta, ratios of 14 to 17. Buying works if you stay 7+ years. Chicago, ratio of 15, but property tax of 1.6 to 2.2% annually adds significant cost. Phoenix and Las Vegas, ratios of 16 to 19. Bought well during corrections. Renting makes more sense during appreciation peaks. Charlotte and Nashville, ratios approaching 18 in desirable submarkets. Tampa and Orlando, post-pandemic appreciation pushed ratios to 17 to 20. Buying in neutral cities requires a longer horizon and discipline to not over-leverage into an appreciated market. U.S. cities where renting dominates. San Francisco, price-to-rent ratio of 38. A $1.4 million median home rents for $3,000 monthly. The math doesn't close. New York City, ratio of 30 to 35 in Manhattan, 25 to 28 in outer boroughs. Los Angeles, ratio of 32. Seattle and Denver, ratios of 24 to 26 post-correction, still elevated. Boston, 22 to 25. Austin, despite price corrections from the 2022 peak, still sits at 19 to 22. In these markets, renting and investing the down payment in a diversified portfolio has outperformed buying for most 10-year periods since 2010. International cities where buying makes mathematical sense. Tokyo, Japan's property market has effectively flat nominal appreciation for 30 years, but price-to-rent ratios in outer wards run 15 to 18. Financing is available at 0.6 to 1%, and the carry cost is low. If you want a home and plan to stay, Tokyo is more rational than San Francisco at one-third the price. Istanbul, ratio of 8 to 12 in established neighborhoods. Inflation hedging via hard assets has been critical in the Turkish lira environment. Tbilisi, Georgia, ratios of 9 to 12, foreigner-friendly ownership, and rental yields of 7 to 9%. Bangkok, ratios of 14 to 18 in prime condos, yields of 5 to 6%. International cities where renting dominates. Amsterdam, price-to-rent ratios of 28 to 35, rent control on legacy units, and near impossible purchase process for non-EU buyers. Buy nothing. London, ratio of 30 to 40 in central zones. Buy only if holding as an investment with professional management, not as a primary residence. Sydney and Melbourne, ratios of 30 to 45. Sydney median house at 1.4 million AUD on rental income of 45,000 AUD annually, ratio of 31. Renting in Sydney and investing in diversified global equities has materially outperformed buying for the past 15 years on risk-adjusted terms. Vancouver and Toronto, ratios of 35 to 50. Toronto's ratio is now comparable to the most expensive American cities at a fraction of the income level. Break-even analysis across cities. Detroit, break-even at 2 to 3 years. You're better off buying after year 3 in almost all scenarios. Indianapolis, Memphis, Kansas City, 3 to 5 years. Charlotte, Nashville, Tampa, 6 to 8 years. Austin, Denver, Phoenix, 8 to 12 years. New York, Los Angeles, San Francisco, break-even stretches to 15 to 20 plus years, meaning the majority of Americans who move every 7 years on average are statistically better off renting in expensive coastal cities. This is the most counterintuitive but data-supported finding in real estate economics. The American homeownership imperative causes financial damage in high-price-to-rent markets. The verdict across 20 cities. Strong buy markets. Detroit, Cleveland, Indianapolis, Memphis, Kansas City, Birmingham, all with ratios below 13 and break-even under 5 years. Neutral markets. Dallas, Atlanta, Chicago, Phoenix, Charlotte, Nashville, buy if staying 7+ years. Rent-dominant U.S. markets. San Francisco, New York, Los Angeles, Seattle, Boston, Austin. Rent and invest the capital differential. International buy opportunities. Tokyo outer wards, Tbilisi, Bangkok, Istanbul, all with rational price to rent for long-term residents. International rent-first markets. London, Amsterdam, Sydney, Vancouver, Toronto. Avoid purchase unless holding as pure investment. The framework is the same everywhere. Run the price-to-rent ratio, calculate your break-even horizon, and let the math decide, not the cultural narrative. If this analysis changed how you're thinking about the rent versus buy decision, subscribe for more data-driven real estate research. We cover markets and metrics most real estate content ignores. Every week, new numbers,